a quick update. Well, first of all, my name is Brian Wohlfeil. I run the employee benefits at Market Financial Group. See a lot of familiar faces. Thank you all for coming, especially for the new ones. We try to do these lunch and learns quarterly, but it kind of runs into 2-3 times a year because we don't want to kind of overdo it with, too much new content. Because the good news in health insurance is there's always kind of new content lately, and at some point it gets a little like Affordable Care Act compliance fatigue. But here's where we're at now. The ACA, the Affordable Care Act, looks like it's not going anywhere for the near future. For those of you following the news, the latest Graham-Cassidy bill, as you may know, McCain said no early. 2 of the Republicans said, we don't support this, so they didn't bring it to a vote. So when it comes back for another vote to repeal, replace, or Republicans have their way, just repeal it, we'll see. But as of now, it's definitely kind of business as usual. So which is kind of good, at least from a broker standpoint / company standpoint. We can kind of move on and say, okay, this is what we have now. This is the devil we know, so let's not try to figure out the best way to navigate through it. So I'm going to go through, to kind of give you a quick agenda, I'm going to go through about 3 or 4 kind of quick renewal strategies that we're telling our clients kind of look out for. And then we've got LifeLock. So we made a switch. We were going to do this thing called Healthiest You, which is, we'll do that another day. But since there's been so much talk about LifeLock and security breaches and personal information, I thought that was pretty topical. I mean, on the way to the meeting here, I had the radio on. I heard 2 LifeLock commercials. So
we're good.
So they are really kind of getting the name out. So that'll be the best part of the presentation, LifeLock. So I'll save that for last. Ooh, and there's a share. I think we'll be like. I'm going to use the drawing book, so you should. We will have I can't. And I did not give you guys this information early because I know you guys would all cheat it. Okay, so what this is so a lot of our December renewals, this one's going to be probably a little bit more geared. I know we've got different size companies here. This one's going to be a little more geared to the 2 to 50 market. Right now, the 2 to 50 market is you're either community rated, which means you're probably involved in the Affordable Care Act, and your pricing is based 100% on your demographics. So you basically get a big grid. A 64-year-old costs this, a 22-year-old costs this, and it doesn't matter if you have $1 in claims or $1 million in claims. You're getting renewals kind of with the group. There is what I call kind of a loophole going. So there are 4 fully insured carriers that have the Affordable Care Act. So if you guys get a bad increase for your December 1st renewal, the 4 main carriers are Blue Cross, United, Aetna, Humana. So if you're one of those, you're going to shop 3 other plans. Within the Affordable Care Act, there is some rate variance between the carriers. UHC is kind of pretty hot right now with some of their plan offerings and their networks. But they're fairly bunched. I would say from a plan design perspective, for the most part, there's maybe not more than 10 to 12% difference between the Blue Cross United plans. Would that be about safe?
Yeah, to be in general. It varies quarter by quarter.
There we go. So that's the way to shop it. The nice part is it's very easy to shop it. In the past, we'd get a quote. We'd spreadsheet them and be like, here's your rates, but everyone's got to fill out those medical questions, and it can get rated up anywhere from 0 to 67%. The good news is that's gone. So your rate's your rate. So when you get that spreadsheet, you can say, all right, if we leave Blue Cross and go United, 10%, and that looks pretty good, we'll go ahead and do it. So that makes that part easy. Now comes kind of what I consider a bit of a loophole in the Affordable Care Act for this 2 to 50 market, and that's called level funding. And level funding is going to look, smell, feel like fully insured. You're going to pay your monthly premium just like you do on your fully insured plan. But the huge difference is those quotes will get underwritten. So basically, if you are a very unhealthy group, you're like, Affordable Care Act, sweet. I have these rates. I know we have a ton of claims. I get to lock in at this. That sounds good for me. But if I'm in that, if you think about what that pool is going to be, That person who says great knows they have a lot of claims. Well, then it's kind of what I think it's going to happen. It's going to kind of be like the individual market where they're going to get adversely selected upon a little bit. Meaning, if I'm really unhealthy, I'm staying in the Affordable Care Act. If I'm healthy, I'm going to check out what this level funding is all about. And all you need to do with this level funding is really, in some cases, submit applications, medical applications, for certain size groups, which we'll get into a little bit. As long as I get a little bit more detail on a census, we can have two of the major carriers underwrite that, so we'll kind of know where we're at on that. I'm going to do an example. So what this first page is showing, I won't spend too much time. This is actually a real-life client. I asked them if I could use them. We're implementing them now. Their renewal Blue Cross Blue Shield, they got like an 18% increase. These are renewal numbers. So basically, they've got two plans, it's G510 and S508. So at the end of the day, they were going to pay for next year, the next 12 months, $194,000 in premium. So we shopped the market. They had 16 on plan, and the fully insured ACAs were all closed. So in this case, we did an apples-to-apples fully insured. How does Aetna compare against Blue Cross Blue Shield? So in this case, we're at $198,000. So again, I'm not going to pay 2% more to go from Blue Cross to Aetna. No play there. So if you take a look at the second page, this is going to be what the level funded quote looks like. So again, on the left-hand side, we have $194,000. I did an apples-to-apples plan comparison. So this, you'll see there's three boxes. So from an apples-to-apples plan design comparison, we're looking at the underwritten cost and $121,000 annually, or I think $73,000 in annual savings. So I'm like, okay, well, we've had a lot of savings here. What if we just throw everyone on this great plan on the right-hand column? $500 deductible, $3,000 out of pocket, better than both the plans they have with Blue Cross Blue Shield. If they put everyone on that plan, they're still at $138,000, or 29% less than what they're going to get with Blue Cross Blue Shield. So you can see pretty significant savings. And those were underwritten. So there are a lot of groups that if you've got one major medical thing, they're either going to decline a quote or they're going to give you a huge number. But if you're relatively healthy, you want to be rated on your own and not with the people that are saying, oh, good, gosh, I'm glad I'm community rated because I know we have a lot of claims. So that's just the pure numbers behind it. I know self-insurance, this is classified under self-insurance. And that is why it's not subject to the Affordable Care Act rules, and that's why I think it's a loophole. I'm going to get into how those dollars work now and why I think it's a loophole and why I have no fear moving my group to a level funded, because I know if it runs bad, and if you're in the 2 to 50 market, I'm just going to jump back in the community rated pool. We know how easy it is to get quotes on that. So how this works is, if you take a look at the third page, you can see the breakout of the premium for my Aetna quote. But I actually am going to use the fourth page as my scenario, because United Healthcare does a lot better job of kind of showing what your dollars go to. So right now, when you're on your Blue Cross Blue Shield plan, if they were to renew with Blue Cross Blue Shield, they basically would have cut a check to Blue Cross Blue Shield for $16,000 a month. It didn't matter how good or how bad they run, that's what they're going to pay. How level funding works is you're basically going to pay a lot more in fixed costs because you want to protect yourself against really bad claims. We know if I have $180,000 in my pool, I've got one premature baby, it's going to blow through that. So you know you're going to have a lot more protection, but you pay for it. So basically, I'm going to use these United Healthcare numbers. This $121,000, the UHC and the Aetna quote were very close. So this premium for the whole year is going to be $121,000. So instead of the $190 plus, this one's going to be $121,000. So how is that money spent? You know, if I'm self-insured, where do all these dollars go? If I have $20,000 in claims, do I get $100,000 back? No, that's how kind of real self-insurance would work. This is kind of like a baby step of self-insurance. So what you pay for is, you pay for your network discounts. We all know when we go to provider, we want to go in network because bill charges may be $180, but my discounted amount may be $110. you pay for that network, so you pay a cost for that. You also do not want to get into business to be a claims payer. So what TPA stands for is third-party administrator. So in almost all cases, your carrier is going to be your third-party administrator. So United's going to help pay the claims in this situation. Then you're going to pay specific stop loss. And what's specific stop loss, and the amounts can vary, but what they're saying is that premature, that's not the best example, another high claim dollar, anything over 25,000 gets sent to the reinsurance carrier. So only 25,000 for each claim occurrence will go against that number. And then in my opinion, the most important part is my aggregate stop loss. And what the aggregate stop loss says is, on your worst case scenario, we're going to protect anything over $121,000. So I know at the end of the day, I'm done. $121,000. And again, if I had a huge claim year, guess what? You're going to get such an unfavorable renewal, you're going to head for the hills. I know moving carriers is not the easiest thing in the world, so we hope that doesn't happen. But it's nice to know you're protected to go back. And heck, you could even go back. You could actually keep the same carrier and just go back to that community rated, which is going to be kind of back at that $190,000, depending on what your renewal is. So level funding's been around for 7-8 years, but it's really had a lot of momentum because of the Affordable Care Act and what that's doing to the group health insurance pool. So 12-1 renewals for those that had them are averaging 15-20%. We're seeing a lot of traction for this level funding. What is also very nice is if you have at least 15 enrolled with Aetna, so the two main carriers that are doing this level funding, so Blue Cross is doing this level funding, but they are really going about it very slow. In fact, I got an email from my Blue Cross who showed up and said, yeah, we've sold 0 so far. Our pricing isn't even close. So they're not ready yet. So basically we've got Aetna and United, and Cigna does some too. They've been in the field the longest. They're a little bit tougher on underwriting. So I've been dealing mostly with Aetna and United. So what's very nice, and we're going to talk about GRX in a minute, when we talk about maybe some more on the 50-plus side. GRX underwriting has made the shopping process a lot easier, because I could say, before I got this underwritten, they actually got no rate up, but this number was 121,000. But what I would have said is, okay, I need all the applications from employees, I need to see their medical conditions, and they do the underwriting. If you're at least 15 enrolled and 20 enrolled on UHC, they can actually do what they call GRX underwriting. This scares me a little bit, but it makes the process a little bit easier, because what GRX underwriting is they're basically, once you get the census, I got everyone's name and everyone's date of birth. They send that off, and they basically pull all the prescription data for each person and what they think and what they think with their the backing with their dollars is. They think they can see what kind of risk they're getting based on what kind of prescriptions you're taking. So they can kind of see if it's a group they want to take or not. The good news is employees don't have to fill out applications. So we can get underwritten rates without doing that employee doing that work. So we can get rates behind the scenes. And in this case, it's a no-brainer. 190 to 120. Some people don't want to leave Blue Cross for Aetna. No, all things being equal, I probably wouldn't either. But for $70,000 in savings, and they got a 20% increase. So now this guy can either save $60,000 and keep the premiums the same. What I said is, look, maybe just keep the premiums the same as that, and the same as they are, and kind of save that for a rainy day, because we know 10%, 20%, 20% increase. So, or the employees could have a lot lower contribution. But either way, having 30% less costs is something that they just couldn't pass up. And I wouldn't have either, not for that kind of money. Does anyone have any questions on how level funding works? Yes, that's a great question. Absolutely. So, yes, you have to do applications though. But, I talk about both sides. It's, if you've got 10, 11 on plan, it's, it might be worth kind of taking a peek at it. But yes, absolutely. Thank you. That's a good question. Ooh. Right. Did I do this?
It worked yesterday.
So I was at my last job with Heather. This guy got this coolest thing. I like the whiteboarding, you know, I can't draw. So he got his wall painted with this really cool paint that you can write on. You can write and erase, and it's really neat. Day one, permanent marker. He draws all over it. And the boss happened to be around. He's like, Patrick, you sound like you're having some problems. And he had to go as far. He knew Patrick. But I did get my white wall, so. All right. Again, I did not pass these all out because I knew you guys would cheat. Oops, sorry. Just one, sorry. You guys can find your own. This one will be a little. Actually, you guys mind? Come on, Kathi, get those longer arms out there. Go ahead, Kathi, your long arm. So before this year, so right now, you know, I'm a salesperson, so I get to help on the department, but why I'm here is to hopefully get more groups, and that's something that's fun for me. So my main strategy really is kind of that level funding education, because you'd be shocked, and Robin here can attest. So Robin worked with with how many brokers? Hundreds and hundreds.
As a company, probably 2,000. It's personally probably about 400.
It's amazing how some of the broker community is just great. They kind of keep up with all this stuff. It's a really good living if you can do well. But it's also amazing how many people out there just have their head in the sand and I hate Affordable Care Act and Obama ruined it, and they don't kind of keep up with these things. So the broker community is a little bit aging. So even though I have gray hair, I still feel like I'm one of the younger brokers out there. So some of these concepts, if your broker's great, you'll be hearing them. But if not, I think you might want to hear some of this stuff. So before level funding, my number one pitch is always doing an HRA. And what an HRA, it's called a health reimbursement arrangement. And unlike an HSA, if you've heard of those before, what an HRA says is it's a promise to pay claims that are covered by the plan should they happen. However, if they don't happen, you don't pay that out. And we'll kind of go through some examples as we go through here. So this was a real life case last year. I just pulled one. I wanted to make this one a little bit smaller. As the numbers get bigger, as the group gets bigger, the numbers obviously get exponentially bigger. But this group was on a Blue Cross G517 plan. So they had a $1,000 deductible. And after that, there's a 90% co-insurance up into a maximum of $4,000. And that's kind of, I like to look at the out-of-pocket. And that, in the past, I'd say was one bucket. And then your other bucket is your ER visits, copay. Oops. Office visit, 2040 for specialists, and then the drug card when they can use it. If you want to know it's not the right one. In the past, I would say, hey, this is the second bucket. Prescription copays don't count towards out-of-pockets. Well, one of the good things about the Affordable Care Act is any plan that's part of the Affordable Care Act, all of your copays actually do count towards your out-of-pocket maximum. So the bad news is if I have a $4 ER visit, that's a lot of money. At least it counts towards my out-of-pocket, where in the past it didn't do it. So when I look at this plan, this is a fairly, benefit-rich plan, 18, maybe a little bit better than average. But I know I'll use 6 people. If I have 6 people, on average, I know 3 will use the plan, and 3 just really won't use the plan that much. So I'll use me as an example. I've been good, better. I've been going to get my free wellness visit, so I went in. Other than that, I take one prescription. It's $30 a month, $360. No big deal. I'm a very low utilizer. So why pay for a plan that costs more money when I don't need it? But in case I need it, my company can reimburse me. And then I'll show you the math behind it. So the plan that was really hot last year is the B520 plan. And I also think this is going to be easier for employees. So on this plan with Blue Cross Blue Shield, You have a $6,000 deductible for singles and a $12,700 deductible and out of pocket for singles, and a $12,700 deductible and out of pocket for families. And there is no insurance up until that point. You still get discounts, but if my drug that costs $145, but I'm paying a $30 copay, on this plan, I would be responsible for all $145. So this is literally a catastrophic plan. I don't have any insurance minus my discounts up until $6,000. The good news is, after that, it's 100% paid by Blue Cross Blue Shield. So at least I know that's my final determination. But if you offer this plan to your employees, they'd be very upset because most of them use it for copays and most of them use it for prescriptions, and it's a big change. However, now let's look at the cost. So the cost in this plan up top was $15,000 monthly, or a total of $180,000 for that G517 plan. What Blue Cross is going to get from me on this $6,000 deductible plan is $107,000. So I have $73,000 less that I'm going to pay Blue Cross Blue Shield. Now here's where it gets fun. So I can play Santa Claus, and if you look at this annual reimbursement liability, I just said, hey, let's make the plan better and let's save the company some dollars. So I'm going to give everyone a debit card of $5,000, and I'm going to give everyone a debit card of $10,000. And remember, this is only paid for things covered under the plan. So this is actually a qualified high deductible health plan that I could open up an HSA. So what qualified high deductible health plan, if you ever hear I have an HSA plan, they have a qualified high deductible health plan that allows them to open up an HSA at any kind of banking institution. So, but since we're going to give an HRA, we're going to take in this case, you cannot do an HSA because the key of an HSA is you have to have no first dollar coverage up until I think $1,300 or $1,400. So this is not an HSA plan. And that's good too because I want to protect these employers' dollars. So I'm going to give everyone a debit card of $5,000 and $10,000 on it to be used only on health insurance costs. So I don't want to pay for things not covering health insurance. This is not a separate bank account. This is, hey, how can we make our benefit plan as good as we can? So if I take a look at the liability, so how much is out there? So great, we have $70,000 in savings, but I've got all these debit cards out there. So all you got to do is figure out, I've got one employee, so that's $5,000. I've got two employee spouses. I'm going to give them $10,000. Pretty nice. I've got no employed children. I've got three families. I'm also going to give them $20,000. So my maximum liability on this plan is $45,000. So if everybody spent every penny of my reimbursement, I will take that $107,000. Oh, $55,000. I just did that math. Oh, I need to do it. So if everybody spent every penny of these dollars, I'm on there for $55,000. There's a fee to do this. That's probably a little high, but I don't have the debit cards. We outsource that. If everybody spent every penny, you are still saving $16,000. Pretty good. And the benefit plan, it's hard to say I've got $5,000 of free money, and in a worst case scenario, I've got $1,000 out of my pocket compared to a potential $4,000. I mean, there will be zero people that be worse off on this plan. So it's kind of you're kind of getting a win-win. You're getting a win because you are taking a less of a benefit plan. And these health insurance carriers in the past have just really promoted this because they hate copays. Now, they've gotten a little bit better because they're giving you a bigger ding on the copay, but on a lot of plans, copays were $103 for the ER. I've seen some familiar faces, but I'll give another life example because I use it a gazillion times. My wife is a first grade teacher. Second day of school, my daughter falls off the monkey bars, hurts her wrist. They call her in. They said, yeah, you should probably take her to get some x-rays. So my wife calls me, insurance guy / husband, and says, hey, I'm taking Kate to Edward ER. We're getting some x-rays. I said, did you try to urgent care clinic? It'll be easier, faster. I'm kind of ingrained in that. She's like, well, I'm almost there. I said, okay, go ahead and go. Let me know how it goes. And the reason I did that, because she's a first grade teacher, She's got a $75 ER copay and a $50 urgent clinic copay. For $25, she wanted to go to Edward ER. Happy wife, happy life. Go ahead. Well, that bill was $3,800 or $3,600. And all they did was not even cast it. Literally X-rays, and she came out in a sling. $3,800. It would have been about a quarter of that for the urgent care clinic. So I can tell you, if I was on a plan where I had a $10,000, debit card of free money, I'd be like, oh no, honey, Plainfield Urgent Care Clinic, we got to do this. You'd be like, okay, that's fine. So it would change my behavior. Same thing with brand name drugs versus generic. $35, my doctor, it's a brand, it's probably better. For $35, I'm not going to make a change. But if I'm paying the full price for discounts, there's a lot more people that really take, it's health insurance. One of the last things, we don't know what it costs, right? We've been talking about getting more transparency, talking about it. I'd say it's been a big thing for the last 5 years. We went to a seminar the other day. That's the best I've seen in a while. I'm doing a demo on it, but it's still not here and it's still not free. So they want people to become consumers. So I like the math part of this. This doesn't work all the time. It used to work almost all the time. Blue Cross specifically has kind of caught on to some of this, at what brokers are doing. These plans, so this plan, I did an analysis. This plan got an average of 16% increase for all their groups in the ACA. This plan, 30. So they're catching up. I've been doing these HRAs for about 5 years. Kind of as I like the numbers part of it. I can tell you how great I am, but if the numbers are good, that makes a lot of sense. So I've been leading with HRAs in all my groups every year, probably until this year, because they have taken some of the savings out. But for something like I would have said before, if you're on this plan, I can make it better 9 times out of 10. Now it's down to like 3 or 4 times out of 10. It's not 100% no-brainer, but definitely worth taking a look at. And how the debit card works is pretty cool. So you can't go to Best Buy and buy like a TV. They're all linked to merchant category codes. So it'll like gas stations, it'll ding it automatically. But what did happen when these things first came out was I'd go to Walgreens, I'd get my prescription, and I'd get my 12-pack of Diet Coke. Now that they have beer, I don't like to get my beer with it. Those things would go through in the beginning because you were at the right swiper, but they fixed it. If you ever go to Walgreens now, you can see like FSA eligible event. They're kind of more smart on that kind of stuff. So it really does kind of protect your money because the average utilization is around 50 to 55%. Now, in this scenario, there's only 6 people. I even feel bad giving an average because 6 people is really there's not enough critical mass to make a percentages work. But if you run good and you're at 50%, you only spent $55,000. So you went from 180 to 137,000 in premium. And no one could argue. What some employers would do is like, ooh, 5,000? Let's give them 4,000, right? I try to make it a win-win, but at the end of the day, it's your guys' money. So I do what I'm told.
If the money isn't used up on the credit card, is that then?
That's a great question. That is a great question. So what I do is I never have them roll over because I can then, and I like to do the HRAs as early in the year as possible. It gets more complicated if you have a 12-1 renewal because calendar deductibles work on a calendar year. So if you took that $6,000 deductible in December, you had that deductible. If you had something big happen in December, in January your deductible starts all over because deductibles are always going to work on calendar years. But to answer your question, I usually start the card at 12/31. Balances are done January 1st. Then the company can say, okay, we'll do 5,000, 10,000 again. I use the savings off my utilization, so I always start the debit cards over on January 1st. Even if I start you at like a 2-1 or a 3-1, I make that first year like a 9-month HRA, so I'd still do the same scenarios. And then every January 1st is when I would do my reallotment with HRAs. I've done about 30, maybe 40 of these HRAs. I've never seen anyone go from that plan back to a copay plan. And I rarely, they don't even tell me, I rarely see people change their election. So if you did 5,000, 10,000, I haven't really seen people go change it throughout the year just because there's not enough on it. So you can roll it over, but it's just going to eat away from your savings. And I think it makes it a little bit more unclear. So then what would they get the next year, especially if it's pretty benefit rich. So you can, I don't, which technically makes it a MERP, but we're not going to do it. So it's HRA is good enough. All right, I'm going to do one more quick 10 minutes. This is so good.
It is exciting.
I know. I love it. Isn't that sick? This one is going to be Blue Cross centric. So one of the things that is going on with Blue Cross now, if you wanted to buy an individual policy, they've got their big PPO, which is the biggest in the state, right, Robin? Robin represents nuclear. Blue Cross's main PPO is the biggest in the state. No?
I think UHC goes, it really depends on the
She's with UHC, so take that with yourself.
Yeah, but I mean,
Okay,
Blue
so
Cross Blue Shield has the consumer recognition that
I'm with you there. I think that perception is overblown.
It's actually a little bit larger.
All right, I used to like that Cranes thing that came out. So then they have their Blue Choice network. So just for UHC, who's got a little bit smaller of a network,
Yeah.
but their second network is really good. Their second network is way better than Blue Choice's network. So if I go on an individual plan right now, if I had to get individual insurance, I can't buy this. I have to buy this. So what Blue Cross is now